Today we're talking about adding implied volatility and historical volatility studies to your thinkorswim platform. I think these studies are very good because they'll let you know if volatility is extremely high for a particular time for a stock, and it'll let you know if you should be selling premium or maybe buying premium using like some bull put spreads or something like that. Now, we all know that implied volatility is usually higher than realized volatility, and that typically volatility is mean reverting, meaning that if it's above the average volatility for that time period, it tends to trend towards the historical volatility. So let's go ahead and jump right into this and show you how to add the studies, and then we'll talk about it a little bit more. So what you're going to do is on the top right here, on this little flask, you're going to click on Studies, then Edit Studies. You're going to click on here and then type IMP for implied volatility. Double click that, and you'll see it pop up over here. After that, delete IMP and then type in historic, and you see historical volatility come up. Go ahead and click on that, and you see it come over here as well. I like to have them on the same graph, so I'm going to take this and drag it up one slot, and just going to put them both on one graph. Now, what the historical volatility is going to be looking at is 20 years of data for what the actual volatility was for that stock in that time period. So that's what that 20 stands for. If you want a shorter thing that follows more current trends, you can click this gear icon and change the length down to whatever you want. So if you want to just do the last 5 years so you stay on more current trends that are happening with the stock, you can do that. I'm going to go ahead and click Apply. And now you're going to see a new graph come up in the bottom here, and this is your implied and historical volatility. Now, stuff that you will be looking at is seeing when these guys cross or when implied volatility is low. Those might be times that you might want to buy premium or perhaps just sit out and not sell premium if you're purely a seller. Because typically, if the implied volatility is lower and the historical volatility during that time period is typically higher, typically you're going to see the stock move or the volatility move up. Which we know if volatility increases, the price of your contracts is going to go up. So if you're selling contracts, you're going to be losing while this volatility increases, which may make you nervous and close out, even if your stock price is not coming up to your strike price. So if the blue line is lower than the pink line, you may want to not sell premium because we know that volatility tends to be mean reverting. I mean, it tends to go back to historical prices or historical levels. However, if the implied volatility is higher than the historical volatility by a significant amount, that might be a good opportunity to sell some premium, because if the volatility decreases, that's going to suck out premium from your contract, putting you in profit quicker, so you might not even have to wait for theta to get you those gains. So that's just another thing to look at to see if you can get the best price for selling your options or buying your options if you like to buy options. So using this tool along with the other tools available to you in the thinkorswim platform, you have you really get a lot of confirmations that an opportunity is really there that puts the odds in your favor. So if you want to check out some of these other tutorials of stuff that I use in thinkorswim, go ahead and click on this playlist and you can see everything I use on thinkorswim.